Good afternoon and welcome to the Aviance Capital Partners quarterly conference call and webinar. We apologize for some delays here in the beginning. Technology is not always our friend, so I apologize. My name is Matthew Johnson. I'll be moderating today's call. Today's featured panelist, Jack Brown, Chartered Financial Analyst, and our Chief Investment Officer will give us current market and economic outlook. We encourage our live listeners to submit any questions or comments in the dialog box that you see on your screen. Please feel free to type them in as they come to you, and our panel will answer them following the prepared comments. For those listening on replay, please email any questions or comments to us at wealthrelations@aviancepartners.com. Before we get to Jack's commentary, I would like to take a moment and highlight our most recent wealth planning efforts. Recognizing a need for overall coordination and financial planning, Aviance added Wealth Planning and Guidance Division in late 2017. Strategic hires have helped the firm shift from its original sole focus of investment advisory to an integrated wealth advisory model, dedicated to both investment management and financial planning. As Aviance continues to build out the planning and guidance arm of our business, we are very excited to announce a new planning and guidance hire, James Ashbridge, CFP. James comes to Aviance from TD Ameritrade, where he had an 11-year career highlighted by a list of professional accolades. James is a certified financial planner. He is based out of Orlando, Florida, and will help Aviance expand their consultative coverage model throughout Central and Northern Florida. Aviance is very fortunate to have James and proud to welcome him to our team. This update in personnel gives additional strength to Aviance's unique value proposition, a proprietary investment platform with friendly, personalized service and comprehensive guidance. Our planning and guidance continues to focus on the major wealth planning areas of retirement income planning, estate and trust planning, tax management, education funding, charitable giving, risk management, and cash management. Aviance has the ability to aggregate outside accounts and report them together in one concise, cohesive plan document. We have trademarked our planning and guidance process, and it is called the Aviance Wealth Plan. Many of our clients have already taken advantage of our wealth planning services. As a reminder, these services are offered to all of our clients, both new and existing, and are included without an additional fee. For those clients that have not had the opportunity to start their Aviance Wealth Plan, my planning partners, Jack Campbell, James Ashbridge, and I urge you to take the opportunity and let us guide you through the financial planning process. If you have any specific wealth planning questions or would like to schedule an appointment, please contact us here at the office. Now that you've heard a little bit about the wealth planning and what we have to offer, it's time to hear from the investment side of the house. I'll pass the presentation to our Chief Investment Officer, Jack Brown, for his comments on the market and the economy. Jack?
Thank you, Matt. It's going to be a good presentation. There's a lot of very interesting things going on in the market and the economy. And, of course, we're looking forward to presenting what we see to you. And hopefully you appreciate our efforts. So with that in regard, we'll jump right into it. Here we have kind of an outlook of what we're looking at. The structure for today's discussion, there's a lot of ideas that the economy is at risk. It's certainly something to consider. So we're going to look at that, but we're also going to look at the argument against the notion that the economy is at risk, and that's really the idea that the economy is actually doing pretty good. So, the question is what are we watching, and ultimately what's the case for stocks and things like that. So that's the overall structure. So jumping right into it, the argument for the notion the economy is at risk, sort of a debate-style discussion, if you will. There are certainly a lot of items in the news, and from our perspective, some of the things we do see are rather tangible, things we need to consider closely as we go. It's going to keep us on our toes. But that being said, the stronger argument of the two is later on in the presentation. So with that, I'll get right into it. When we look at certain factors in the economy, we see some things that are not necessarily good. We see this regularly. Even when times are good, you'll see some statistics look positive, some look negative. Right now, the theme that's building is that on the industrial or manufacturing part of the economy, that's where we're starting to see some weakness. So one of these areas is heavy truck sales. And with this chart, we're looking at year-over-year sales growth, and we actually see it dipped into negative territory most recently. and that's basically saying that less trucks are sold today than there were a year ago. And this is an indication that there's just less buying of heavy trucks. Maybe that means that there's the less need for them and less economic activity among those parts of the economy that need heavy trucks, whether it's mining or shipping or anything having to do with those sorts of vehicles. On the next slide, we'll take a step back. You know, obviously the heavy truck sales are down a little bit. We look a little bit more broadly at the broad industrial production, if you will. This is still kind of that manufacturing area and broader industrial production index. This index has a slightly less false positives, meaning that when this does go negative, it's typically associated with a recession. Now, we had a big false positive at the end of 2015 into 2016. If you look at this chart, you see the blue line dip into negative territory. But the economy turned out to be just fine. Here we are about 3 years later, and we're in this kind of no man's land right now where we just dipped into negative territory. So this is one of those things where industrial production is saying, let's be careful here. There might be some smoke, so that means there might be some fire. This is certainly a pretty good argument if you're worried about the economy. This is good in the sense that good in terms of bad, I should say, kind of jokingly. So in other words, something to pay attention to. The other thing to look at in terms of industry and manufacturing and things like that, what are the managers? What are the guys on the floor who are producing things and they're kind of in charge of production? What are they saying right now? Their confidence is a bit low. How do we know this? There's something called the Purchasing Managers Index. It comes out by ISM, and when that number gets below 50, that means they're less excited about what they see in the economy, and that's where we are now. They're not very excited for the next 6 months to a year in terms of the type of activity they see, the things they'll be purchasing, hiring plans, etc. So this is one that a lot of economists like to zero in on and say, you know, that this could spell trouble ahead. So we're starting to see a case being built. A lot of it is focused on that industrial/manufacturing part of the economy. There's definitely a theme there, no doubt. Taking a step a little bit further back, looking broadly at the corporate structure, corporate America, how is that doing? Well, this includes service firms, and we know at this point a lot of our economy includes service firms. But when we include service firms to that broader corporate structure, we look at overall corporate debt. This includes loans, bonds, things like that. So corporate debt, when we look at corporate debt, and this is, I believe, was in the last quarter's presentation, but this blue line on this chart is showing us the level of corporate debt relative to the size of the economy. And what you'll notice is when that peaks, that peak is often associated with a recession. Just visually looking at this chart, it appears as if we're close to a peak simply because we're higher now than previous peaks. So this is kind of an interesting point to look at and say, are we pretty close to that next recession? So that's a good question. The green line, by the way, is interesting because what that shows us is the option-adjusted spread. It basically, in simple terms, when the corporate bond market is selling off, you'll see that green line spike up. So those spikes, you'll see, are often associated with recessions. As you may recall, back in 2016, a couple slides ago, we saw that dip in industrial production. We also saw this spike in the corporate bond market. So corporate bonds actually sold off at the same time industrial production came in a little bit. And so that's why we see that spike around that 2016 time frame on this green line. But this is showing us that when corporate bonds sell off, it often happens when the corporate bond market has issued too much debt. So the questions right now is there too much debt? Are we close to recession? Are corporate bonds getting ready to sell off? Good question. Stuff to help us worry. So here we go. Next slide. So One way to tie in corporate debt to the stock market is to look at this slide, and this blue line is similar to the line in the previous chart that was showing us times when the corporate bond market sold off. When we see spikes in this blue line, it's telling us that corporate bonds have sold off. When you look at those spikes and compare them to the S&P 500, which is the orange line, you'll see that the spikes are often associated with dips in the S&P 500. So we're seeing a theme here. How does that corporate bond market tie into the stock market? Well, there's definitely some linkages here and enough to help build the case that the economy is indeed at risk. And so that overall the case is looking kind of strong. So stay tuned, because we're going to have the other side of the argument, which is also very strong as well. But finally, to wrap up the concerns we see with the economy, here we're looking at profit margins. So this goes back to the idea of overall corporate profit margins. It's collected by the Bureau of Economic Analysis, so this is economic-wide data on businesses. And what we see that corporate profit margins, that's the profits relative to the size of their revenues. And in our case, we're looking at aggregate profits relative to the economy. What we see is those margins have come in. It looks like they'd be at basically normal levels if you look at history. But the scary thing is that as profit margins are coming down, it simply means there's probably going to be less money that can be used to pay interest and pay off debt. So the theme of having too much debt and profit margins coming in, that's something that we need to pay close attention to as well. That wraps up a fairly strong case that the economy is indeed at risk.
Jack, you mentioned some of the headwinds the economy is facing and a pickup in economic warning signs. But is it all doom and gloom? Are there some bright spots that signal continued growth in the economy?
Yeah, I think there is. It's always interesting to put the bad news. Where do you put that? You put it in the beginning, or do you want to hear the good news first? In this case, we opted to hear the bad news first. So the other side of the story, if we think there's two sides. The first side, I think, deals squarely with what's going on in corporate America, and particularly what we see on the manufacturing industrial side of the economy. That's where we're seeing some weakness. You can blame it on a number of factors, but that's really where it's all tied into. Of course, the overall corporate bond market is part of that story, but that's the negative side. The positive side really gets to the consumer. The consumer is very important for the U.S. economy. It represents about two-thirds, clearly the majority of economic activity. So the health of the everyday person financially is really important. And so that's where the news gets rather good. So the argument against the notion that the economy is at risk is just another way of saying, what's going on in the economy that's good, and that's the consumer. So with that, this is where we look at labor statistics and that sort of thing. The first chart we're looking at is all employees. We're simply taking a very easy comparison of how many more employees are there this year than there were a year ago, and you can see when that blue line is in positive territory, it's associated with continued growth in the economy. The gray bars being the periods of recession. So when we see the employment growth go down, it dips into negative territory, that's associated with recession. Right now, the employment situation is good, and I think most people are aware that people are getting hired with some regularity. Other interesting things that aren't in this presentation, there are more job openings than there are people actually looking for work, and you see just a consistent level of statistics that point to the idea that the employment situation is pretty good. Another thing to point out is that households, which is consumers, it's collectively their households, they have less debt overall. In fact, household debt is likely normalized. Here we're looking at household debt relative to household net worth. And what you'll see is that it's come down significantly since the 2008 time frame. and it's come down to pretty normal levels. So this is a good sign. The consumer, who is responsible for so much in the economy, is gainfully employed, and they have a lot less debt. So the typical financial stressors that you see in your average household is pretty normal, normal in a good way right now. Another area to look at are the leading indexes. You can look at a variety of factors in the economy, and some of these are more predictive than others. When we put them together as a group, this is the Federal Reserve Bank of Philadelphia, when they come up with the leading index for the U.S., that index is saying, hey, the economy looks pretty good. We do not see any sort of problems right now in the economy. So that's obviously a good sign, just kind of a broad metric looking at future economic growth. The last thing to point out, this goes back to the idea of employment. Wages are climbing, so this is a good thing. Not only are people working, there's plenty of jobs. There's not a lot of household debt. People are also getting wage increases, so that's obviously a very good thing. And there are other things to point out, but collectively, right now, the bad news focuses on what's going on in the industrial part of the world. The good news has to do with the consumer. So that makes the case for the idea that the economy is doing pretty good.
Jack, thank you for presenting both sides of the argument. Although it's nice to hear that there are positives with the current stock market, it's important to note some of the downside risk and economic warning signs. What are other types of things that you're paying attention to in the current market?
That brings up the idea of what are we watching. One thing that you could already take from the first part of the presentation is that we're clearly watching the corporate debt market, corporate bond market. That's an interesting place to look at. Another area where we're looking, and this is where we get a lot of very good data, has to do with the employment idea. If part of our argument that the economy is doing pretty good is that the consumer is doing well because they're gainfully employed, we want to pay close attention to that part of the economy. So here, for example, this is the initial unemployment claims, and what this is showing us is that the initial unemployment claims are essentially current at record lows. This is pretty unbelievable. We haven't seen initial claims this low since the early 70s. Now, the interesting thing is it's a much bigger populace. So we have a lot more people in the U.S., but the initial claims is a lot lower. So that's very interesting. The thing to pay attention to here is that you'll see the initial unemployment claims, when it kind of hits these cyclically low periods, then it turns around and starts to go up. And that means there's more initial unemployment claims. And that's important to watch, because what you'll notice is that when this data point starts turning up, the stock market does not like that very much. So we're paying pretty close attention to this. It's a weekly number, so you get pretty good information. But when you start to see a trend, among other factors, it's something that needs to be paid pretty close attention to, and we're certainly doing that. This is, and you'll have to forgive me, this is probably the most complicated slide in the presentation, but we've had a negative yield curve, and you've probably heard about that in the news. The basic idea is when long-term bonds have lower yields than short-term bonds, that is essentially what a negative yield curve is. It's also an unnormal thing. It is also associated with recessions. In other words, recessions tend to happen after we have a negative yield curve. We had one not too long ago. So that's something to point out. That's the red line, effectively. The red line is showing us the 10-year treasuries minus the 2-year treasuries. When that goes below that zero line, that is showing us a negative yield curve with that particular red line. When we look at the blue line, this is showing us the number of employment. This is basically changes in the employment participation rate. So when employment participation goes down, that's a bad thing. That tends to precede a recession as well. So even though we've hit a negative yield curve, the employment participation has held up rather well. So this is something we're watching. We're clearly, uncomfortable a bit, as a lot of people are, with the negatively sloped yield curve, but you see this strong employment that hasn't really budged at all. So it's one of those areas where, again, we're paying close attention to the employment situation, in addition to the corporate bond market. So that is essentially both sides of the argument that the economy looks good, or there are certain weaknesses in the economy. How does this tie into the stock market? What is the kind of the net result, and what are maybe some market-related items to kind of bring it all together? So the idea that there is a case for stocks, we're in that camp. At the end of the day, the economy, we believe, is going to continue to grow. There's always going to be a good amount of good news and a good amount of bad news. We feel the good news is going to dominate the bad news, but we also believe that the stock market appears to be in relatively good shape, so we should expect normal returns. That's where we are. That's our base case, if you will. How do we get there, aside from the idea that the economy looks pretty good on balance? So the case for stocks, first of all, we are in a low interest rate climate. So, a lot of investors have a choice to make. Should I buy bonds or should I buy stocks? That's a good question. In a record low interest rate environment, it's not abnormal for people to say, I don't like bonds right now because rates are so low. That's a normal result. The other thing we would consider is the relative valuation. If you can look at the valuation of the stock market, whether you're looking at price-to-earnings ratios or discounted cash flow models or simply different ways of comparing the stock market to the bond market, the stock market looks pretty decent right now. So that helps us feel comfortable. And lastly, the idea that the economy is growing, even if there are recessions, they happen about 10% of the time. That means 90% of the time the economy is growing. And what goes along with the economy, it's essentially businesses. The bigger the economy gets, the bigger businesses get. And generally, we think of revenues, basically that money coming through the front door. So even during recessions, it's quite normal to see businesses continue to grow. So we have this backdrop of what we feel is going to be a growing economy, and we're also likely to see continued business growth regardless. So given these three factors, we think the stock market looks pretty good right now. So to zero in on that just a little bit more, a real easy way to compare income, if you will, the stock market dividend yield minus the 10-year Treasury rate. This is one of those things you can track over time. Right now, when you do that simple difference, that simple yield difference, you see the dividend yields in the S&P 500 is higher than 10-year Treasury rates. So that's a good thing. If you go back to a longer period of time, this chart doesn't show it, but for a 50-year period from 1959 to 2009, Treasury yields were higher than dividend yields in the stock market. That's a pretty interesting thing. In 2008, the stock market went down. As a result, dividend yields go up, just by the way of the math. So dividend yields went up quite a bit in 2009, and they went up higher for the first time than Treasury yields in quite a while. Since 2009, you see that blue line kind of go up and down. So it's been a back and forth battle between who's got the higher yield. Right now, stocks look better than bonds from this very simple metric. So that means that a lot of investors, who gets the jump ball the stock market does for a lot of investors. Last thing I want to point out is that this is a chart that shows $100 in S&P 500 dividends. We start in 1970 and we come to the current period. And what you'll see is that $100 in dividends grows quite a bit, almost to $2,000. That's a pretty staggering level of growth in dividends. It simply means as businesses get bigger, they pay more out and turn more of their earnings out in the form of dividends. So that's what's going on here. The other interesting thing to point out, this does not assume that we're reinvesting those dividends. This just simply means that $100 you get in dividends, if you owned enough of the S&P to get those $100 and did nothing, you would get nearly $2,000 in dividends today. So that's a very interesting factor. Compare that to bonds. When you get income from bonds, from fixed income instruments, you get a coupon. That coupon does not change over time. It stays fixed. That's why it's called fixed income. And so that's something to point out, and that's why you see dividend growth, which is a very interesting thing. Now, the other idea to point out is your typical company grows. That's just a normal state of things. So that means the typical company that pays dividends is growing their dividends. So, there are plenty of good strategies out there, but it's normal for any dividend, any sort of dividend to increase itself over time. You would expect that for most of the companies that pay dividends out there. One final thing to point out with this slide is that red line simply shows you how fast inflation grew. So inflation grew from $100 and it grew sixfold since 1970. Not nearly as much as the growth in dividends. So that's another fun fact to point out. All right, I'm going to just quickly summarize here. So if we're looking at big risks in the economy, it's going to relate mostly to what we see in manufacturing companies. Clearly, we've seen a bit of a slowdown there. It's something that needs to pay pretty close attention to. We don't want to see that get too bad. It could spread. It could lead to more layoffs, which is something we're sensitive to. Another area that we're paying attention to is high debt levels. At some point, the debt levels will come down. I mean, hopefully it happens in an organized, longer-term fashion where it's not going to have too much damage on the broader markets, but that's something we are paying attention to as well. Some of the employment statistics look like, things are at a peak right now. Initial claims on unemployment looks very low. It's obviously a good thing. Is it? Some people might argue, well, it's kind of an end of the cycle. So it's something that's you can make the case for on either side, but it's something we're paying close attention to. The positives relate to the consumer. The consumer is responsible for so much of the economy. They're employed. There's plenty of jobs. Wages are going up, and they don't have a lot of debt. That is a very good foundation for continued economic growth. The other thing to consider is the market itself looks to be in pretty good shape. So there's a lot of things to be comfortable with right now. On balance, our base case is for a normal market, continued economic growth. We do expect to see continued volatility. There's enough things going on in the world that we didn't necessarily cover today, whether it's trade issues or impeachment issues or things along those lines. Those are certainly in the news. They will have some impact on a day-to-day basis on the markets. We don't see any of them having any kind of derailing effect to the overall economy or the markets. So we didn't really cover those areas too much, but they certainly could lead to some kind of pullback, could certainly lead to a correction, a 10% correction or so in the market. We don't see any of those other sort of global macro issues driving the boat from a bigger picture standpoint right now. So, we're basically concluding with the idea that the consumer will win today, and so we're keeping an eye on how well that consumer is doing. Our best metric for paying attention to that are kind of the employment statistics. And that's the summary. So I'll turn it back to Matthew at this point.
Jack, thank you for your insight. Before we open it up to the live queue for questions and answers, I'd like to start with a couple of questions that were emailed over the last couple of days. The first one, Jack, what are the most attractive sectors that you're finding ideas in right now, given the current market and the economy?
Good question. One area we seem to find continued value with, it's done fairly well depending on which part of the sector you've looked at. In the financial area, we continue to see a lot of attractively valued financial companies, whether they're banks or insurance companies or card processors, that sort of thing. There is just a ton of technology being applied to that area, and it seems like certain companies are positioned to win and are attractively valued. So we're pretty excited about what we see there. Healthcare, broadly speaking, it has been rather ignored. It has not done that well up until last quarter. It hasn't participated nearly as much as other sectors. And what we find, and this has kind of been the case for kind of a long time, but we're starting to see a lot of companies that historically have traded PEs in the high 20s and 30s. There's some that are actually trading in the single digits or the low double digits, which is not only unusual, but very interesting, because this is where much of our country's greatest innovation is taking place. And these are very well-funded companies. So some of the news has been, not that great. There seems to be a lot of overreaction to individual compounds and drug discoveries and things like that. But the whole sector has been under fire somewhat. You could call it. There's some political concern with how healthcare is going in this country. But that being said, you take a step back and you look at the broad sector. It is incredibly cheap for an area that's probably going to experience faster than normal economic, growth faster than the overall economy. So that's an exciting area as well.
Now, the second part of that question and the other side of the coin, what's your biggest concern in the market right now? What sector or asset classes worry you the most?
There's always room to worry about in a lot of areas. Some of the, from my perspective, a lot of it is a bottom-up story. We're really looking at companies with high levels of corporate debt. We do see that as a concern. We do consistently look for companies that do not overextend themselves, and those will tend to win the day. So a lot of it is a bottom-up story. In terms of another area, you could look at valuation. There's certain areas that look more expensive than others. Nothing seems to me dramatically out of whack, if you will, but there are some sort of old line, stable, what people might recognize as high quality companies. But you look at their overall growth levels, and they're in that mid-single digit range. But you look at their price to earnings multiples, and they're 30 or so, and the two things don't really add up. So they're high quality businesses, but they're trading at a kind of a premium given the level of growth. So in my mind, a lot of that question can be answered on a stock by stock basis.
Thank you. Another question that come in is, what products do you have that are more defensive in nature?
Well, the one area we do for certain clients, if you're really looking at defensive as a very high, strong objective, our strategies kind of address different areas. So we do own individual bonds for some clients. For many clients, the challenge is that yields are low. That being said, most people are willing to accept a reasonable yield for a good level of protection. So we're generally able to come up with solutions that help us for those clients. I'd also consider one of our strategies, which we call our Core Plus Fixed Income strategy. That one takes on a little bit more risk. There we're focusing on a lot of funds, some exchange-traded funds and some closed-end funds. We have a fairly long track record at this point. It goes back to 2006. So a multiple range of environments, and in that case, it's tied squarely to the bond market through funds, and that's got a defensible nature as well. And then lastly, if you're looking to reach out a little bit further on that risk reward spectrum, you could consider our enhanced income strategy. That's going to have exposure to both the stock and the bond market. And there, our number one focus is income. So it's not necessarily downside protection, but indirectly, because it has an overall balanced type of allocation, you'll get some downside protection. This year it's done very well. It's participated in a good way, to a good degree that the stock market has done. And we try to position it so that it doesn't get the same sort of downside as well. So that's the goal with that strategy. So that's how I would answer that question.
Okay, now we'll move on to some of our questions that were posted in the live question and discussion forum. This one's a little bit more forward-looking, but with interest rates low right now, you had mentioned that the bonds being low as they are dividend stocks attractive?
I think they are. Dividend stocks, there's always going to be a place for high-quality businesses that pay dividends and take a portion of their earnings and pay them out. In this low interest rate environment especially, that's the case. If you can buy a reasonably priced company, a company that's not too expensive, by looking at things, a variety of metrics, just the PE ratio is a simple one that most people are familiar with. Buy one that's not overly priced, that takes a portion of its earnings, pays it out in the form of dividends. If it's a good business, the chances are it's going to grow over time, so you get a decent yield, plus you get some income growth over time. So this is a really good time to consider dividend-paying stocks.
Another forward-looking question that came in: are you carrying more cash in your portfolios going into an election year?
I'd say we are carrying a bit of cash. It's normal for us to carry a bit of cash, but we're not carrying an above normal level of cash due to the upcoming election. This could change over time. I kind of prefer to steer clear of political discussions in relation to the investment strategy. But I think it could be argued that there's a couple candidates on the left that, were they to be the Democratic nominee, that it could cause some strains in certain sectors of the economy, whether it's the financial services area or other areas that would lead to a dramatic difference in how some companies operate. So I would say that is a concern. There is a chance that, under certain conditions, we would raise more cash due to what's going on with the election, but at this point we have not.
A general question had come in: does the move to passive investing create more or less opportunities for you to invest in individual stocks?
I think it from my perspective, and this is kind of an academic question in a lot of ways, but from my perspective, I think there's always going to be interesting opportunities for individual companies, and there are areas of the stock market right now that are very attractively priced relative to history, and so that's one way of making the argument that the exchange traded or the passive vehicles aren't making things what you would call super efficient across the board. So I think there are a lot of areas where you see pricing where you can take advantage of opportunities. So I'd have to say no to that question.
The last question that we have in our queue, is the classic 60-40 allocation to stocks and bonds still attractive now in these markets?
Yeah, I think there's always place for that. The allocation, the reason you would have a moderate allocation, I would say that likely falls into a moderate type of camp. There are generally, there's generally arguments for having fixed income. We do get income from fixed income. That's clear. We're in a record low interest rate environment. But for a lot of people and for a lot of, a portion of someone's overall goals is understanding how much risk they're willing to take. So on a case-by-case basis, you would want to say how much risk is someone willing or able to take. And if the answer is, they need to be careful with some of their investments, then for sure you would want to have some fixed income. So from a long-term strategic allocation, I think a 60-40 mix is fine for many folks. You could make the argument that tactically, year to year or even shorter periods of time, that you might want to emphasize stocks or bonds, depending on what we're seeing. But I think the case for 60-40 or 70-30 or 80-20 is as much about the individual investor as it is about the climate. The fact that we have low interest rates, I think, does need to be factored into the overall determination of an asset allocation. But it's only one of many factors.
Thank you, Jack. That concludes our question and answer period. Should you have any additional questions, concerns, or comments, feel free to contact us here at the office at 239-598-4747 or at wealthrelations@aviancepartners.com. Lastly, and certainly not least, we'd like to take this opportunity to thank you all for your business and to wish you and your families a very happy Thanksgiving. Thanks for listening to our quarterly call, and we look forward to speaking with you soon.